Welcome to another edition of Capital Ideas, where we get to meet the people behind the portfolios. We get to hear how they joined Capital Group, a little about their early career, their investment edge, some of their ideas. Should be an interesting episode today. Today we have Mark Casey joining us. Mark Casey is an equity portfolio manager based in San Francisco. He's been at Capital Group for 23 years. Welcome, Mark. Thank you for joining us.
It's good to be here, Mike.
So you are a podcast consumer, from what I hear, and you listen to them on very fast speed. First of all, do you listen to ours on fast speed? So how fast, and what's your favorite podcast?
For podcasts, 1.75. Some of them I can listen to at 2 times.
Okay.
And I love podcasts because there are so many podcasters who will take you a mile deep, and you can really learn about whatever you're interested in. So 3 I love are... one's by Robert Bryce, and it's about how electric grids work, and it's called Power Hungry. Another is by Paul Saladino, who is encouraging me to eat the same sorts of foods my great-grandparents ate and not eat highly processed modern foods. And then the last one is one of many podcasts I've listened to learn about Bitcoin, and it's by an Australian named Stefan Livera. So the Stefan Livera podcast.
Okay, great. So I don't want to start getting too personal, but I will. A little birdie told me, and the little birdie may or may not be named Carl Kawaja. A little birdie told me you had an interesting story on your first date with your wife, Carrie. I don't mean to put it out there, but please share.
The part Carl knows about is the day after that date. My first date with Carrie was incredible. It was in the summer of 2005. We met in the Mission District in San Francisco, got crepes at this little restaurant called Tiku's, went to see a sketch comedy show by a group called Killing My Lobster, which is still doing sketch comedy. And then the next day I woke up and I thought, man, I could really see myself marrying this girl. I should ask her out again. So I went to my email and sent an email to Carrie and told her what a great time I had on Friday night and asked if she wanted to get brunch on Sunday. And then all day Saturday, I kept hitting the refresh button on my Gmail, and she just did not respond.
Ghosting you.
Just completely not responding to my email. And so eventually I thought, what did I do wrong in this email? So I went in my sent items folder and realized that when I typed CAR, Gmail suggested as an autocomplete my colleague Carl Kawaja. So I asked Carl Kawaja out for brunch and told him what a great date I had. And once I figured that out, I emailed Carrie, and the rest is history.
That is funny. He didn't tell me that part. I love that. So let's get to your career at Capital Group. As an analyst, you covered a lot of different sectors. You covered media, internet, a bunch of different sectors. Tell us a little bit about some of the ones you covered, and then how did they inform? I think document imaging was another one. Mm-hmm. How did they inform your role as a diversified portfolio manager?
Well, I think one of the main lessons I picked up as an analyst was you need to have really good peripheral vision. So newspapers were these incredible businesses. Warren Buffett famously bought 2, and they were local monopolies, and they didn't get killed by other newspapers or by magazines. It was really, their economics kind of got gutted by Craigslist and eBay and Zillow and Monster.com and old job boards. So it was just stuff that people in the industry never saw coming. Or, a great company like Xerox, which was one of the Nifty 50 stocks. I think it was kind of more than anything else the iPad that really made that company struggle, because now you could bring all your papers to a meeting and you didn't have to print them out anymore. Right. The Yellow Pages kind of got creamed by Google and Yelp, and the cable networks. When Netflix came out and first started mailing DVDs to people's houses, I didn't think, you know what, that's going to gut the economics of the cable networks and change that whole industry, but that's exactly what happened. So I learned to be very paranoid about seemingly insignificant things on the horizon and to take them very seriously.
And you become a diversified portfolio manager. And one of the biggest themes in your portfolio is digitalization and how that's changed the world. Tell us a little bit about that and how it manifests itself in your portfolio today.
Well, all those examples I gave were digital. And the newspapers suffered because of digital. The Yellow Pages suffered because of digital. And so at some point I started flipping and saying, well, what's going to do well because of digital? And so that's kind of what my portfolio is built on now. And it's been built on it for ever since I became a portfolio manager in 2011. I just think digitalization is going to continue for a long time. And it has created some unstoppable trends that are transforming industries. Like, people don't watch cable TV by appointment anymore. They get Netflix or Hulu and they stream it. Another digital trend is paper money and coin money is disappearing. And digital money, I think, will take share of all payments for pretty much the rest of our lives. On-premise computing, where companies like Capital Group have data centers and buy their own servers and run them, that's giving way to cloud computing. And that trend, it's so big. The biggest cloud computing companies add up to maybe 160 billion of revenue, which sounds like a lot, but there's another trillion and change revenue
just getting going.
They don't have yet. And so I think these digital trends are just really powerful.
And you had a piece that you wrote, you and a few other associates wrote a piece called The Long View, and you were talking about mega trends. First of all, I thought it was a fantastic piece. But in your section, you talk about AI, but in the form of robotics, not just large language models. And I love the Sparrow example from Amazon. And I think you said something to the effect of when it first started 7 years ago, that same concept at Amazon, there was a high fail rate and it took a while. And now of 100 million items in an Amazon warehouse, 65 or 70 million can be picked and packed within seconds, something like that. Tell us a little bit about AI robotics and why it may be more important than what we're looking at now in large language models.
I think large language models are really exciting and they can transform white collar work. Robots are something that have just chronically been disappointing. We all watched sci-fi TV shows and the Jetsons growing up, and there were robots in all of those, and we thought, oh, wouldn't that be amazing if it happened? But so far, the only really popular robot is the Roomba. And it's sort of like an adequate way to vacuum your carpet, and it's an amusing way to get cat videos on YouTube. But there haven't been any really good robots yet. But I look at that Amazon Sparrow, that picking arm, which can pack boxes. That's one of the most tedious jobs at Amazon. You put 200 items an hour in a box, you're at risk of getting repetitive motion disorder. And that product just kind of solves a lot of that. And it came out of nowhere in the last 7 years. My favorite robot is one you can actually drive around in, I think in now 4 cities, which are those Waymo self-driving cars. They're ridiculously good.
Are they?
Yeah. One of the best things about them is if the app says the Waymo is going to be at your corner in 3 minutes, it's really going to be there in 3 minutes. Unlike,
which is unique.
Unlike you think it's 3 and it takes 9.
Sure.
And they're incredibly smooth driving. So I've taken a few of those Waymos around San Francisco, and they're also now in Los Angeles and Phoenix and in Austin, and they're rolling out to more cities. And I think for the last many years, it's always seemed like self-driving cars were 8 years away, and now I feel like maybe they're 3 years away. So I'm excited about those. I'm excited about drone deliveries. Walmart is testing drone deliveries to your house in Dallas-Fort Worth this year.
So I've heard mixed things on that. Is it working? What have you heard? Because I've heard very mixed reports on how accurate it is and how scalable it is.
I bet it's going to be like most things in technology, which is you'll get overexcited about how good it could be in 2 years, right. and then it'll be a hype cycle. And then 10 years later, you'll look back and say, wow, that turned out to be huge. We just overestimated the timing. But we'll see. They've done hundreds of thousands of successful drone drop-offs in Australia and in Virginia. But Texas, it might be different. Who knows? I mean, it's really hot in Texas, and it can be very windy in Texas. And, how are the drones going to stand up to 105-degree heat and 30-mile-an-hour winds? We'll find out.
We'll see. I want to get into some ideas you have and into some stocks. But before I do that, we do, as you know, an office treasure hunt. We did go in your office. And one thing we got in your office, and I'll describe it to those folks who are listening. We have viewers and listeners. It's called the Richter Scales. It's a CD, an old-fashioned CD, and it says, "We hate acapella." So obviously there's a story to this. Tell us a little bit about, and I can give it to you to spark your memory, but I'm guessing I don't need to. Tell me the importance of that. It's in your office, so it must be important.
Well, the Richter Scales is a men's a cappella singing group that I co-founded in 2000. And it was guys all around Silicon Valley and San Francisco for the most part. And we rehearsed every Thursday night and put on concerts. We actually had a very successful YouTube video called Here Comes Another Bubble, which won a Webby Award the year it came out. So people can check that out. And I was the business manager of the Richter Scales, and I was in charge of getting concerts for us. And so what you could do at that time was go to Google, and this was, maybe in 2005. So Google's only a year old as a public company. And I could go bid on anybody searching for singers for a party or a cappella groups or concerts in San Francisco. And there weren't that many people using Google to buy ads at that time. So the minimum price per an ad was just 5 cents a click. And it was
5 cents.
5 cents every time somebody clicked on your ad. And it was just the greatest deal in the world, because if 1 in 20 clicks resulted in a concert, we would pay $1, and we charged $500 for the concert. So we'd have $499 to spend on dinner and beer afterwards. And it was just this great return on investment. And starting in late, maybe 2005, Google started raising the minimum price of the bid. So first it was 5 cents, then it was 10 cents, and it got all the way up to $1. And it was still an incredible deal, because now I'm paying $20 to get a $500
Still plenty
gig.
left over for the team.
Yeah, and I was the Google analyst at the time, and I had already recommended and liked that stock. But one of the most, kind of confidence-inspiring experiences I've ever had as an equity analyst was seeing this company raise my price by a factor of 20, and I still thought it was an amazing deal. And if they could do that to the Richter scales, I figured they could do that to most of the world. And so that's one of the reasons Google makes so much money now.
So do you still own it?
I still do. Yeah, Google, if I continue to hold it as of August, which I imagine I will, I'll have held Google consecutively for 20 years.
Wow.
Yeah.
And so if you held it then, and there was obviously, you were early to it, why now what's the outlook? It's obviously a very large market cap company now, grown a tremendous amount. What's the story for the next 20 years?
Well, it's, what I did every one of these, call it 77 quarters, where I've analyzed Google's financial results and updated my model and written up the company, or at least recalculated my estimates. I'm always trying to look 4 to 8 years out and trying to make my best guess at what sort of money will the company be earning at that time, and what will its future growth prospects look like at that time. And I use those two things to calculate a range of target stock prices, and I compare them to the current stock price. And if there's enough appreciation, I just kind of say, well, I think I'm just going to sit around and wait for 4 to 8 years to see if that comes true. And to me, what's been surprising about Google over these 20 years is, one, just how many ways they found to be inventive and add new things that nobody was expecting when they went public. Like YouTube is a gigantic business now, $40 billion of revenue. They didn't own it when they went public. Android, they bought for $50 million after they went public, and that's the world's most popular phone operating system. Waymo, these self-driving robot cars, I think that could be huge, and it's not in the stock price.
At all. I mean, you don't, when you look at the stock price, you see zero Waymo.
Right. If I take out all the parts, Google Cloud Platform, Google Search, Android, YouTube, and I kind of say, how much is left over for Waymo? I don't see the stock market paying anything for Waymo. So I think search will continue to grow, not as fast as it used to grow, but I think YouTube, Android, Chrome, Google Cloud, their Gemini AI team, Waymo, this thing called Verily, a life extension or a healthcare company. I think they've just got a lot of irons in the fire, and it looks attractively priced to me.
You're a successful portfolio manager. I don't mean to embarrass you, but you are. And all Capital Group associates who manage money have had their moments where something just went poorly. Share an experience, because you learn from that.
Yeah.
And the stories we've heard from past guests are just great in how they've taken a lesson from some failure and gotten even better. What's one of Mark Casey's failures?
Well, one of my epic disasters was the second time
Epic disaster. I mean, you took failure to a new level there.
Yeah, it was the second time I owned Yahoo. The first time I owned Yahoo was coming out of the crash after the implosion of the internet bubble. And from 2002 to maybe 2005, it was a great stock. And I sold it because I thought it got too expensive. But I bought it back a couple of years later. And I I had just several bad quarters in a row where I had all these ideas on what I thought Yahoo could do to be more successful. I had all these visions of how they could compete more successfully with Google and all these ways they could charge for their products. And then Microsoft made a bid for Yahoo, which increased my confidence further. So I doubled my position. And then Microsoft said, we don't want to buy this. We found a way to compete in search without owning Yahoo. And the whole thing fell apart.
Right.
And it was just a disaster. And the lesson I took away from it was, it is hard enough to make money in investing when you and the management team are on exactly the same page as to how the industry works and what the company should do. And so what I concluded was, if I'm actually disagreeing with management about how the company works and what the industry should do, under no circumstances should I own that stock, because it's hard enough when you're both totally aligned.
So does that stick today? I mean, if you're not aligned with management and their strategy, you won't own the company, even if you think the growth prospects for the company, even if it's not perfectly managed, are high.
That's right. I think if I come out of a meeting and I feel like, I disagree with them on several aspects of what they're trying to do, I figure there's 500 stocks in the S&P 500 and there's 2,000 stocks in the Russell 2000, and maybe I can find one or two more that I really feel like I leave the meeting and think, wow, they are on the right track.
Other opportunities. On the other side of failure is success, and you've had a lot of success. What's your investment edge? We ask all of our guests, and I'm always just excited about the answers. No pressure. Excited about the answers because they're all different. Everyone's got a different edge. Mm-hmm. What's yours?
Well, I think one of my edges is I have a very high willingness to tough it out if I think the prize at the end of the suffering is worth it. So if there's a large enough prospect for financial gain, I will take almost any amount of pain in the short term to just sort of wait it out for that to come true. And the way that shows up is, if you go ask all our analysts, what are your ideas that have the highest return in the next 5 years? They'll come up with a list. And then if you say, hey, what of all your ideas has the most downside risk in a recession, or if the economy turns south in the next year? They're going to give you a list, and it's kind of usually the same list, right? The thing people think can go up the most in 8 years is often the thing they think can go down the most next year. But when I see that set up, I say, well, I'm going for the 8-year
I'm going
number.
early. I could be early as long as I get the payoff at the end.
Right. And people will say, Mark, you own a lot of these things that could go down 30% in a recession. And I'll say, you're right. And if it does, I'm just going to sit there and wait it out, because if they come roaring back and we get that 8-year number, if the analyst is right and I'm right about that 8-year number, it's all going to be worth it in the long term. And, there's lots of other portfolio managers who won't take that much near-term downside risk. And that's one of the good things about the capital system. But with many other people being appropriately cautious about the next year, there's room for me to be extremely focused on 8 years.
So when you have one of those companies that you own, and it does go down 20 or 30%, and the long-term, or you have a strong conviction the long-term payoff is there, will you add more to that position as it declines? Meaning, initially, do you buy 100% of your intended position, or are you willing to sort of average in over a period of time? How do you think of that?
Yeah, if I really think a stock is likely to keep going down, I will buy a third and then buy another third as it goes down and buy a final third at what's the bottom. But, I think of it in terms of baseball. If I'm the batter and I see a pitch coming and I think, I can hit that ball, and it's a strike if I don't hit it, I will swing the bat and connect and try to connect. You know what I mean? So if the price strikes me as attractive enough, I will go for it. I never want to be in that situation where I look at the ball coming and think, man, that's an easy pitch. I could hit this for a triple. But I bet the next pitch is going to be even easier and I could hit it for a homer. And then what if the pitch doesn't show?
Right, it doesn't arrive.
And so I'm often early on the downside. But at the bottom, I recently did an analysis of every stock I've lost money on in the last 5 years. And the list, frankly, Mike, is longer than I wish it were. But one thing I've noticed is on some of these great businesses where I really had a lot of conviction, I didn't lose any money on them because I never sold them low. I can really get into barnacle mode, and I can attach myself to the hull of the freighter, and it can be going through icebergs in the Antarctic, and I'm like a barnacle, and I'm just on there.
So you're a strong holder through adversity.
Yeah, I can stick to my guns. I can be very stubborn.
Unless something changes in the story, obviously.
Right.
But
if the future prospects are no longer what we thought they were, then all bets are off.
Got it. The market today, heavily skewed benchmark, and lots of folks are talking about opportunities in small and mid cap, dividends, stocks outside the United States. Just as the market broadens, what's your view of the broad market today, and where are you finding opportunities?
Well, people talk about the 7 to 10 largest tech companies as though they're all overvalued, or they'll talk about them as if they're all one big stock, and you can just treat it as these 10 companies as one thing. I take them all individually, and I see some good values in growth companies still. But I think where I'm finding it easier to pencil out good returns is in a couple of super hated industries. I like it when the market is pricing an industry or a company as though the business is going to shrink every year for the rest of time.
Right.
Because then all you really have to do is make the call, well, could it at least be flat or maybe just grow 1% a year?
Alan Wilson was a guest recently, and Alan said something to me about you. And he said, when it comes to investing, Mark Casey is one of the most intellectually honest people he's ever worked with. What does he mean? What does he mean? Tell us.
Well, he's nice to say that. I don't feel like I'm as intellectually honest as I'd like to be when I
trust Alan. I trust Alan's comments. There's something there.
I think maybe what he's referring to is my policy is to blame everything on myself. It's easy as an investor to say, well, why did I lose money on this investment? And then you can say, well, the management overpaid for this acquisition. It's their fault. But what I try to do is reframe that to, I didn't anticipate that management would lack valuation discipline in their M&A. Or you might think, oh, a tsunami hit their main factory. That's an act of God. It's not my fault. And I'll think, you know what? I didn't fully investigate all the environmental risks. So I just try to pretend literally everything is my fault. And sometimes you'll have analysts say, hey, Mark, I'm really sorry about that stock. And I'll say, hey, it's not your fault. It's my fault. I read your research. I did my own research. I made the decision. I'm responsible for it, not you. And then I try to think about what is it that I did wrong and how can I avoid doing it next time?
I think it's a great lesson for society as a whole, by the way. I mean, taking ownership and not placing the blame on somebody else, which is often super easy to do, would be a good thing across the entire society, but especially in investing, owning up to what goes wrong is really important, and not shifting the blame. And when you look at the very long term, I think our capital market assumptions for equities for the next 20 years is something like 7%. But it sounds like when you're owning a company, you have greater expectations for that company than merely a 7% CAGR over 10 or 20 years. Do you have a target? Do you have an annual target in your mind of, I'm going to hold this company for the long term and I think it's going to compound at 10% or 15%? Or do you not think of it that way?
I do think of it that way, where at least I want to have confidence it deserves to do better than average. The hard part is figuring out how much better than average. Like, I find it very difficult to say whether a company is going to do 12% or 13% or 14%. It's all too narrow. But sometimes you can see a great business that's got better than average economics, better than average management, better than average growth prospects. And it's trading for a discount to the stock market, so it's selling like it's a less than average company. Right. And in that, you're kind of like, well, I'm getting better for less. That sounds like a good setup. I bet this is going to do well. How much better than average? I don't know. But that's the floor is, it has to feel like there's enough cushion over average for me to be interested.
And I imagine with that mindset, you hold very little cash.
Correct. Yeah, I try to hold zero cash at all times.
Well, that's very little.
Yeah, and I do it for two reasons. One is the longer your time horizon is, the worse cash does compared to equities. So if equities can do, say, 10% a year and cash does 2% a year, every 1% of cash you hold is going to underperform by 8 points. And so that's 8 basis points off the whole portfolio. And so I figure, okay, well, if I've got a structural underperformer, let's just not own it. But the other reason I don't like holding cash is the only way I can get a new stock into my portfolio is it has to kick something out. And that's
a forcing function.
Yes. And that's a great way to try to do better than average. All my stocks, I'm trying to do better than the market on average. And then with a new stock that comes in, I have to look at everything I own and say, well, which is this better than? And sometimes I'll be sitting there on a call and one of our analysts will pitch a stock and I'll think, that sounds great. I want to buy that. But then I'll compare it to all my holdings and I'll say, oh, you know what? I actually don't think it's better. And sometimes what I'll do then is appreciate something I own better. Here's why it's not better than this thing I already own. Maybe I should make that bigger.
So zero cash, not everybody does that. It is a forcing function, but it's also a little bit about market timing, saying you're not going to broad market time. You want to be invested for the long term. Like you said, you're willing to take a little bit of short-term pain for the long-term payoff. And I'm guessing that goes into your mentality too. Mm-hmm.
That's 100%. Yeah, I probably am the least oriented towards market timing of anybody I talk to.
So the last topic I want to hit on with you is your private company knowledge. You talked to a bunch of private companies, and someone suggested to me that you have this mindset around ghosts of Christmas future as it relates to private companies. Tell me what that means.
Well, I've had the good fortune through Capital to meet many of the leading venture capitalists in Silicon Valley and many of their portfolio companies also well before they were public. And sometimes that's at the invitation of the venture capitalists. They'll say, look, Capital Group is a firm we respect. We know you're going to be an important voice in the public markets when this company goes public. Could you talk to the CEO and CFO about how they should approach being a public markets investor? And once I was actually asked to give a speech to all of the portfolio companies of a very well-known angel investor in Silicon Valley. And so the theme of the speech was the ghost of Christmas future. And this room had maybe 200 entrepreneurs in it. Many were private, some were recently public. And it was during a very hot part of the market when everything tech-related was trading for very high valuation multiples. Mm-hmm. And so what I kind of told the room, I said, it's really fun to be above average. You're young companies and you're all growing faster than average and you're all valued way higher than average. But if you don't mind me pouring a little bit of rain on the parade, many years from now, the successful ones of you will grow up and be huge companies, and then you'll still be hopefully above average, but you won't be way above average. Like growing at GDP plus 3% or 4% would be a terrific outcome. And in that scenario, you're going to be valued like the average company. And over the last century in the United States, that means you'll trade at 15 times earnings. And there was kind of a gasp in the room because
that's a big decline in multiple.
These guys were all at 15 times sales and probably only 10% of them had earnings. And I said, and by the way, that means GAAP earnings, generally accepted accounting principles, like the stock comp that everybody is ignoring. No, we're going to treat that as an expense. And your depreciation, which people try to ignore when they talk about adjusted EBITDA, that's an expense too. Like the old-fashioned earnings, that's what you're going to trade on. And people were kind of, a little bewildered. But I do find that to be true and be very helpful as an investor. Because whenever I think about, hey, can this company have $1 trillion market valuation someday? To me, the mathematically identical statement is, can this company earn $67 billion a year someday? Because if they can earn $67 billion times 15, that's $1 trillion. And it's often easier to answer the question, how long will it take before this company earns $67 billion than to think about, well, when might the market trade it at $1 trillion?
Yeah, that sounds a little like NVIDIA, where NVIDIA 10 years ago was earning hundreds of millions and today it earns 60 or 70 billion.
Yes, right. And if you got that, then congratulations. That's been one of the best stocks of the decade. Yeah. But that simple math can keep you out of trouble. Sometimes you'll see a car company and it's trading as though it's already trading like it's selling 20 million cars a year. And you say, well, how many are they selling? And the answer is 2 million. And you think, all right, well, if they grow their number of cars by a factor of 10, then the stock's going to be flat. So they have to grow their cars by 20 for me to get a double. So it can keep me out of trouble, but it can also help me see some of these really big things. Like, we talked about cloud computing earlier, and I said, hey, the three big clouds, Amazon, Microsoft, and Google, they only have 160 billion of revenue, but a pretty good chunk of the $1.2 trillion that's not in the cloud is going to move to them over the next 10 or 20, maybe it's 30 years. But when three great companies all have the chance of being 10 times bigger and they're trading for reasonable valuations, that's a setup for an interesting investment.
Were you invited back to speak to these 200 folks?
Yeah, I was. I maintained good relationships. Good. Actually, this particular angel investor in VC wanted somebody to talk about old-fashioned earnings because there had become too big a disregard for the idea of making a profit. In Silicon Valley a few years ago when I did this speech. So in a way, I was doing him a favor by being kind of old-fashioned.
And a realist.
And a realist. That's right.
We end every one of these episodes with an obsessively grateful moment. I will start us off, and I want to share with you, we do have a very oversized mug, but a large mug that says, be obsessively grateful. So I'm going to share this with you, and I'll start sharing one, give you a second to think about your answer of what you're personally grateful for. And I've shared a few ones over the last several months with different guests. This time I'll say I'm obsessively grateful for my wife. And you don't have to say anything about Carrie. You already talked about her. I'm not putting pressure on you in that. But my wife, we've been together 34 years. We've traveled around the world and lived in lots of different places. And I just feel very fortunate that she puts up with me the way she does. And she's an amazing person. Mark, what are you obsessively grateful for?
I'll do two things. At work, I'm obsessively grateful for our analysts. Because especially as a portfolio manager, without the analysts coming up with ideas and defending them and being right about them, man, is this a difficult job to do. So I so greatly appreciate them for carrying me all this time. And, in the world at large, I'm very grateful for inventors, entrepreneurs, and the people who kind of create the innovations and the new knowledge and the new products that have added so much to everybody's lives. They don't just magically show up. Even if you have a free market society, it's not like every great idea will get done. Somebody has to take that risk. And I'm so grateful, especially here in the States, that there are so many people willing to do that, and they do such an amazing job of it.
Innovation. Mm-hmm. Absolutely. Thank you. Always interesting to chat with you. Thank you for joining the podcast. Please subscribe to Capital Group on YouTube or wherever you get your podcasts. Please join us again next time.